Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, July 27th, 2023. Just going to kind of do a quick update here on a couple things to watch. I did post this before the close today, a quick bounce trading up. I want to just start out because this still may play into the after hours a little bit, but again, just a quick bounce. That's why it doesn't make its own front page post. This is a 5-minute chart of QQQ. You can see down here, basically you can see divergent lows, divergent highs, and divergent lows and divergent highs, and then the corrections that tend to follow. So this is just a swing, very short-term swing trading time frame. Some of these trades measure, a percent or so. Some measure a couple percent. So what I noted here, you have pretty good, at least recently, support. Now it's a support level I do think is going to crack. Hence the arrow coming down after, but that's at about 375.40. Lots of reactions here recently. Today's big pop, all of which was 100% faded and then some. So I'm going to talk on that in this video. That's a pretty hard fade that we saw today of the Qs and tech stocks and things like that. But again, you can see here, let me pull a live chart. That was the one before the close today. I'm going to definitely get to VIX for you. I haven't updated that in a little bit. All right, let's see. All right, let's get these lines to load here. And so you can see it's already started. The bounce has already started. And so, again, there's the support level, 375.41. Lots of reactions recently. That makes it a pretty significant near-term level. If and when it goes, you can see to the left of the chart here, you have these big volume of price histogram bars, especially in here in this range. That means the majority of traders over this time period, this goes back all month to the end of, beginning of July down here, end of June. And it tells you this is where the vast majority of trades took place at this price range right here. And you can also see that, a lot of candles in there. Then it's very thin down here all the way to about this point. So the way that works is if and when that support level goes, probably send us back down here. Again, if and when. So there's your level. It's pretty much today's lows. Like I showed you in there, I had a very short-term bounce target I'm calling for, just pop and reverse the close, and that'll probably take place in the after hours session. I would say up to about here, maybe that's about 3. I'm going to round it off. Everyone loves those round numbers. We'll make it 380 right there, and a minimum target right here at about 378.40, and a likely target there at about 380. Now we could do more. We're still in an uptrend. But anyway, so just want to point that out to you. Now let's talk about what happened today. Let's go to QQQ on this 1-minute chart. And what I'll do, let me turn off the after hour trades so we don't get those white candles. So this was today's, there was yesterday's close, popped up. There's the open right there. And this is one of the hardest fades I've seen in a while. And again, this is why I repeatedly talk about don't put too much into what happens on Fed day. It takes a day, usually a couple days, for the dust to settle. And then B, same thing with big earnings, the same exact thing. Don't read too much into the initial knee-jerk reaction when they announce before or after the market closes. Even then, read a little bit less into the post-earnings conference call. It can, not always, but it often takes a day or a couple days, even a couple full trading days for the market to fully digest what's happened. So today's news was really Meta more so than anything. And Meta doesn't move the needle as much as it used to. It is still a top component, but it's down there. It's a $774 billion company. So it is almost a third of what Apple is single-handedly, and it's so it's more than half the size of a Microsoft, but it still matters. Anyways, that's a 2.4% fade today from the highs. That's a pretty hard fade in QQQ. You can see it there. It looks like on the daily chart. You turn off all the lines, you just see a big red candle. So this is this rally starting to get sold into. Again, if you are short or you're a bear, you can't even remotely come close to declaring victory. Sometimes just because something's not going up recently doesn't mean it's going to continue to go down, but it is shows a little change in character, especially since we've already had a correction. Usually the dip buyers come in, but either way, let's keep it simple. Let's not overanalyze it. It is what it is. It's a pretty hard fade, but we're still not too far off the highs in QQQ, and we closed today pretty much again, kind of like the semis, just a hair above where we were a month and a half ago. So, but at the end of the day, we're up. Like I said, you can spin this any way you can spin anything any way you want. You can be glass half full, glass half empty. I'm just giving you the facts, the levels to watch. Like always, my opinion is where we're going to go. So that's pretty much the recent lows, which is also today's lows. Now marks the near-term support level. And a break of that level would likely bring us lower, like I said, on that 5-minute chart, down to down to the next support level. But it could have longer term, and that's the thing about it. Here's the thing. So that's micro analysis. I didn't make a front page post on that little, this QQQ bounce trade that I posted before the close. It's not worth it. Most of you aren't day traders or very short-term active traders. But what happens is if that supposedly, seemingly small short-term support level goes, it has the potential to take out that trend line on QQQ that I've been talking about. This is it on the 60-minute chart. Remember, the way I have it drawn, it comes in slightly lower than the uptrend line on NQ, the NASDAQ 100 futures, and that one's starting to crack again, but not a solid breakdown yet. Remember, we had a little pre-Fed or around the Fed whipsaw, but not even, I won't even call that a whipsaw because that wasn't even a solid 60-minute. I can't even see without looking close enough, zooming in, if we even printed a close below there. And if you have to really squint to see if a stock or an index breaks out or breaks down, don't take the breakout. It's, you should see a clear and impulsive breakdown or breakout, especially on something when you've had such a resilient trend as we have recently in the NASDAQ. Again, don't force it. Wait for a clear breakdown. So that's it. We are below the trend, and now this is obviously a lower close than we had before. But when you look at support on NQ, the NASDAQ 100 futures, it comes in a little bit below. So here's that comparable level. Here, I'll zoom in a little bit, and you can see. So there's that line I just showed you right here on QQQ and NQ, the recent lows we've been dancing on. And then below that, we have couple major reaction highs, and then a breakout right here. That was a breakout. Somebody today asked a question about the semis breaking out, and I want to read my response on that real quick. Oh, before I get there, since that was in another post, I might as well read this response. Someone said, so if we have profit in SQQQ for the day, but do we take it overnight? I'm not exactly sure. The syntax, that's a little off, but okay. So assuming somebody faded the rally today by shorting the Qs and buying SQQQ, which is, if you're not familiar, the 3-time inverse of QQQ, 300% leverage to the downside. So my answer was, if you meant that you bought it today or you shorted the Qs to fade the rally and you're wondering whether to book profits or let it ride, here's one strategy. I can't tell you what to do, but I can tell you what I would do if had that been my thing. I would put a stop at entry or today's lows on SQQQ, which is the same as the highs today on QQQ, and then or you can put it a little bit above that if you want to assure a profit instead of just a break even, and then let it ride, because that hard fade that we had today is pretty bearish in my opinion. So again, that's just one strategy. We still don't have anything remotely close to an all-in yet. There's a couple more big things to report, as I've been saying over and over. We have Apple and Amazon next week. Once they're out of the way, then the charts are the charts. The market's free and will do its own thing. It's either going to burn through these divergences, continue on higher, or all those divergences and everything will finally play out, would be my guess. So what does that look like? Right here. If you shorted or faded this pop today, you thought it was the rally. This is a 60-minute chart. You put a stop right there, because if we go on and do that, and we rally off this level, you're almost certainly going to then take out that previous high. So you're going to go a little higher. At the very least, this market has a pattern of making marginal new highs, as long as they're still divergent highs, then reversing. So again, you can trade it any way you want, or if you faded it, put your stops lower. Guarantee yourself at least a little bit of profit and let it run. That's it. That's how I do it. Now, again, probably get a little bounce, kickback rally. I'd give you a little line right here. This is what I call microanalysis. You can see, you have You have a little high right there, so maybe pop up a little bit. Again, we have major support below and minor resistance overhead. Okay, and Meta managed to close up, but it also faded a whole lot of. There's the pop today, the gap up, and at the low, let's just do at the close. At the close, it had lost 4% of today's gains, which is roughly half. You can also put up Fibonacci's if you want, just to see how much of the gains have faded. Now, at the end of the day, say what you want, it closed up 4.5%. So you can't knock this as too negative, but you can say that, hey, they've so far sold or faded a lot of that pop. And again, a lot of the other NASDAQ components, Apple closed, they were all green earlier. Apple closed red. Microsoft continues to build on the post-earnings losses, down another 2.1% today. Tesla also. Those were the first two I called, down. The first two big tech stocks. No, I'm sorry, it was Netflix and Tesla, but they closed down today, and I don't know where Netflix closed. I haven't even looked at that. Yeah, it closed down too. So Netflix was down 2.2%. Tesla was down another 3.27%. So again, I gave you those check marks. They're all down post earnings, and so it's somewhat of a mixed bag. You have more post earnings losers, down since earnings, and you have winners. But Meta and Alphabet, those are the two. Want to see these faded within the next couple days. Tomorrow's Friday, and then you have, of course, may or may not go into a holding pattern before Apple and Amazon next week. So again, like I said, next week we should know. See if these guys build on these gains or fade them. So that's where we're at. We had red closes in the S&P 500 and the NASDAQ 100, but one single day, and that doesn't make a trend. I did notice pretty poor market breadth. I can tell you I have a real-time market indicator. I'll show you how to do it. I've showed you this before. You move over here. I'm going to move over. Oh, nope, didn't mean to do that. I'm going to take this and drag the screen over here. So you can see this is a component list of everything in QQQ. And if you go like this, if you use TC2000, or maybe your own platform will do this. This is something I figured years ago is a great way to get real-time market breadth indicators. Something I don't think you can get really anywhere, because a lot of them don't give you, they don't have, that I've ever been aware of, breadth indicators for the NASDAQ 100, for example. Or if I want to know what the home builders are, what the market breadth is there, in ITB or XHB, the home builders ETFs, I can do the same thing. And you basically, at any point in the day, sort by gainers and losers. You can see down at the bottom, so Broadcom was flat, so Amazon was the last gainer of the day. And so this, at the very bottom here, I don't know if you can see it. I'm going to drag this down. Right there, it says 33 out of 100 stocks closed green. So that means the other, one was flat and the rest were down. And you can do the same thing with the S&P 500. You can't see it in this screenshot because there's 500 components. So what I do there is I have them sorted by gainers, or you could do it the other way around, losers, whatever you want. Click on the last gainer, and then down at the bottom it tells me here 123 out of 504 stocks in the S&P 500 were positive, and the rest were negative. So that's how you get a real-time breadth indicator. I'm not reading too much into that because, as I always say, one day doesn't make a trend, but it's just something I noticed today. Again, it was a hard fade across the board on a lot of things out there. And let's talk about the semis. Somebody asked, can you talk about the semis? I'm seeing the semis breaking out yet again. Maybe I'm missing something, but here's my reply to that. I consider a breakout, the term breakout, when a security or an index or sector breaks out or below a well-defined bullish or bearish technical pattern. That's a breakout. In the case of the semis, all I see recently was a breakdown of the rising wedge pattern on the daily and 60-minute charts. I'll get to that in 1 second, with semis back testing that wedge from below. Earlier today, as when I covered in the first video, it was a hair above the trend line. Now it's back below it. So I'm not saying the semis can't or won't go higher, only that one should not confuse one up day with a breakout or any other type of bullish technical event, unless that up day did trigger some type of bullish technical event. Again, such as a breakout above a key resistance level, a trend line, a moving average, a bullish chart pattern, etc. So I just wanted to make that clear. And I always say that often. One day, even a big day may or may not be technically significant. And today wasn't in the semis. In fact, if anything, as I do an update there, because I know there's a lot of buzz, I've been covering it lately. There's where we're at. So I know I have a lot of lines here. Let me just color code up what's important to me. This is our primary uptrend line, a target that I believe will be hit in the coming weeks or so. This is a minor uptrend line right there off the mid-May lows. That's the one I was just talking about. And that, taken with these negative divergences right here, form a what we call a bearish rising wedge pattern. We broke down the other day. We danced on this support right here, which I said needs to go next. That we really need to take out that 507-ish level. And when you zoom in closely, so there's our breakdown candle. It's pretty impulsive. We moved sideways for a couple days. We back tested once. Then we checked that 507.23 level once again. Okay, I had to pause it for a quick phone call. Important one to take, but here we go. So breakdown, pulsar red candle. Remember, we are in earnings season, so you take all breakdowns with somewhat of a grain of salt lately, but it is what it is if you want to take it on face value. And then we move sideways 1, 2, 3 consecutive days testing that 507.23 support. Back test number 1, went back down, rejected, tested 503.23. And today, and all that matters on a daily chart, daily candlesticks, is how you close the day. So what this is simply another back test, because we tested that body of that candle closed below there. So we had an intraday pierce, but that doesn't matter on a daily chart. We have intraday pierces there and there. So that's it. So look, you can't knock it too hard. This thing's flirting with pretty much tested the previous highs as well. You can also put minor resistance right here because you can 1, 2, 3, and now 4 levels exactly right there. I mean, within pennies or a penny of that 532.25. So this is our current range, and that's how it works. So if we pop it, big move up there through there, that's going to be bullish. Because you're going to take out those previous highs, you're going to take out the trend line, and of course the way I would expect this chart to play out for what it is, a bearish rising wedge has been broken down, back tested. Want to see an impulsive rejection off here, the redder the better, and especially a break of 507.23, and that should open the door for a move down to the that target there, that trend line. So that is that. Speaking of semis, Intel is on deck today. I was going to fire a post off to you before the close today, and I started to queue up this video, and it looks like their numbers might have been out early, and I was going to tell you that remember, it was Tesla. I had an almost identical chart, and I believe I did talk about this on Intel recently. You had a primary downtrend line that's as clear as a bell, bear market downtrend line, and we checked it before, and I could see easily a pop up, one more thrust up, and again they just reported tonight, and possibly an overshoot of that. And there's an uptrend line right here. Divergence line. Any marginal new high would still be, even an equal high or a new high would be a divergent high. Simply extend the divergences. And so that would be a perfect scenario, just like Tesla, to come up and hit that on earnings, or in this case after earnings, and get rejected. So that was then, of course, the bell rang, and by the time I looked up, they're already popping. I don't know if they reported. I don't have the TV on, but I'm seeing movement. So there's post-market, turn it on, boom, to the button. So this, to me, let me make it clear, it doesn't matter whether I got out to you or not, we're there right now. This to me is an objective short entry because you are at resistance. I'm personally not shorting it because I've been talking about Intel for almost a year now. Is one of my favorite, and the only semi I really liked that was, well, the favorite. There were a couple others I highlighted, but this one, we were buying it off this low, trading it up here. We had a couple, last trade was here, T1, T2. Then we broke above that level. This is one that's kind of bucking the trend. I mean, Intel topped long before the rest of the sector and is closer to its multi-year lows and its multi-year highs. And so it could have ultimately popped this trend line. I don't think it's going to do it right away. But let me be clear again. When I say it's objective short, it either pans out or not. What I can tell you factually, I think it's objective because you are at downtrend line resistance and with negative divergences as well. And that's in this after hour session. We'll see how it pans out tomorrow. And the thing about that, when you short a rally into resistance, you have your stops close by, so your loss, your downside is minimal. We already popped that level on the knee-jerk reaction spike right in the after hours, so you'd have a stop somewhat above the after hour session high, and so you're risking a couple percentage points to make what could be, if it's going to head down and continue its bearish trend. Could be there's the trend line right there. Let's tighten it up. Comes right in now to this one here and there, and that would possibly send this stock down to the previous lows or beyond, especially if those the bearish technicals that I've been highlighting on the semis, SOXX, and the other semiconductor ETFs, those negative divergence, the recent trendline breaks and back tests, especially if that plays out. Birds of a feather tend to flock together. Again, Intel's kind of marched to its own drumbeat over the last year or two, but not in a good way, diverging from the sector and then underperforming. But that's that. I just want to point that one out. And I told you I'd talk about the VIX Volatility Index. Let's jump down to the daily chart. Nothing's changed for a while. We've had this big positive divergence building here on the daily chart. We're right back at that low. It started to pop. VIX started to run. And you look at the 60-minute chart. Here's what we're looking at. So this is, again, 60-minute chart of the VIX Volatility Index. You have a pretty clean downtrend line, which we ran into today, right before the close. Remember, the VIX is trading. This is normal hours. It's shut down for the day now. You have positive divergence there. You had divergence at this low right here, small divergence, and it gave you a pop. Remember, the VIX moves big in percentage terms. So that from that other previous divergent low, that was about a 35% pop in the VIX, ran into that 1724 resistance. Now you have this pretty much larger pattern. And again, it makes this, looks like similar to a falling wedge pattern. And, breakout of that would probably bring the VIX up here. I'll give you a target zone right now, an initial target zone, because this is just a 60-minute chart. If it starts to play out, we'll take a look at the daily chart. But there's your target zone, about $20 to $21.50 or so, give or take. And that would be a rally of about 35 to about 45% in the VIX. Remember, you can't trade this. You can't trade the VIX itself, the VIX Volatility Index. You can trade futures on the VIX. You can trade options on those futures. And you can trade ETNs that track the futures. Those are your instruments like VXX. And there's others out there. If you trade futures, I don't have to tell you which those futures are. They're kind of quirky. Same with the options. They have different expiration dates and all that than stock index options. And there's VXX, put in a bullish engulfing candle today. Over time, you will lose your ass on this if you buy and hold, especially in a bull. Even in a bear market, you got to be quick. The VIX itself is a hit and run instrument. Even if you're trading a bear market, it's going to go down over time due to the inherent decay. These things are rolling futures, and even in a bear market, held long enough, you're going to lose money. You got to get in and out, take the hit and runs, take those little, get those divergent lows when they coincide with negative divergences on the indexes and a likely pullback. Again, the odds for a decent, deeper correction are going to go up substantially if my trend line's taken out on the NASDAQ 100, and especially if Apple and Amazon, if the market doesn't like what they're selling next week, then you have that potential to make that 35 to 45% in the VIX, or these should track it relatively well. And let me just get this out because I get these questions all the time. Just like I said, there's different futures in the VIX, then just like there's different futures in the stock indexes, the NASDAQ futures, the S&P. You have the near-term futures, longer term, there's different expirations. And so this one tracks the short-term futures. And so remember, what we looked at over here and what they talk about on Bubble TV is the spot VIX index, which you can't trade directly. And so that's up, 10.61 today, 10.61%. and VXX was only up 4.43. That means the short-term futures didn't go up as much as the spot VIX. And then you have the medium term, I think it's, no, where is it? VIX futures. There's a medium term. Here it is, VIXM. That one was only up 1.6%. So you have different future roles, and sometimes these guys will be up more than the VIX itself. I just wanted to address that because I do get those questions every time there's a move in the VIX and we're positioned for it. A lot of people are, can't understand why it didn't go up nearly as much as the VIX spot index. And again, you just have to check the various futures. Last but not least, I just wanted to talk bonds, both on a kind of a macro picture. You know me, I probably confuse the heck out of most subscribers. 1 minute I'm talking about 5-minute charts on a little day trade or a 1-day trade that might be looking to get a 1% pop or drop in the indexes. And then the next minute I'm talking about 40, 50-year charts going back, or charts going back half a century, looking at long-term trends and interest rates, and talking about the macro picture and where I think the economy is going to be in 5 years, and anywhere in between there. So I covered all. But one thing I'm watching, and I'm a firm believer in, is that we've entered a new secular bull market in rates. I don't think I've yet to hear even some of the old school folks that I respect a little bit more, that I'll see on in the media and articles in the paper or on CNBC or Bloomberg. I don't see many talking about what I see and believe to be a thing, and that is that we've come to the end of a secular trend, a secular bear market in interest rates. I have many charts here. Let me find the right board. Seems all my lines got all quirked up, but this is TYX, the 30-year Treasury bond yield. This is where interest rates peaked. We were in a bull trend, meaning rates were going up, bond prices were falling, and that was coming off the end of the last true long vicious bear market in the we had one really was from the late 60s all the way to the mid 70s with rising rates. And the one constant in the economy is rising interest rates are net negative for the stock market and for the economy. They raise the cost of capital, which makes stifles economic growth, and it also provides an alternative to risky assets such as stocks and low quality bonds, which have been have been forced into. Even Ben Bernanke said that back when this whole zero interest rate policy party started back in the last financial crisis in 2008. He cited one of the reasons for bringing rates down to zero would force investors into the stock market and into riskier assets. They outright said it. It's just something known. If you have a business major background, that to be true in economics and financial markets. So anyways, it's no surprise we've had one of the longest and strongest bull markets in history overall. With we had a few that was a secular bull market in equities, secular bear market in interest rates, and we've had a few, in my opinion, only really two bull markets in the last couple of decades, bear markets in interest rates, and that was back in when the dot-com bubble burst, 2000 to 2002. And then during the financial crisis. In both cases, of course, the Fed brought rates down, interest rates fell, and then we had our rounds of quantitative easing, near zero rates all this time, and then they hit the nuclear button when COVID hit and just took the rates down. But by most accounts, and I've seemed to have some trend lines drifting here, so I'm going to have to replicate this chart right here for you. Oh, there it is. No wonder. Somehow I toggled off log scaling. Let's put it back. There we go. There's my downtrend line. You can see there's that was the secular downtrend line. You had an alternative downtrend line there, and they've both been broken out. So by just about every metric out there from technical analysis, both downtrend lines, previous reaction highs being taken out here. This has all the makings of a start of a new longer term secular multi-year, probably multi-decade rise in interest rates, and it's not going to be straight up. So far the initial leg has been very powerful. We could come in and back test that trend line or not. All I can tell you is that is the most likely scenario. And so, one more thing I want to talk about on macro. So, what I've been reading lately, there's been several articles, and it all makes sense to me about just why the Fed has raised rates from near zero to over 5.25% now, the biggest rate hiking campaign in decades, and the market has hardly blinked. And it all makes sense. And this is hindsight stuff, is that most companies, and I can't remember if it was Barron's or Wall Street Journal, put out an article and they showed the percentage of debt companies, because we were at such low rates for so long. It gave so many individuals and businesses an opportunity, and they've locked in. The chart showed they've locked in instead of rolling. And this is in consumer as well as businesses, where years back, a lot of the debt was variable rate or subject to change, like when you do the those mortgages that reset adjustable rate mortgages instead of fixed rate. And so a lot of investors, because we're at this persistently low interest rates for quite a while, have locked in for at least a few years out. Businesses usually don't go that far, and the average is like 5 years or so. So the point being that this rise in rates has not affected businesses or even consumers, many of which were locked in. Myself personally, I refied at 2.49. That was coming in from like a 3.5. I thought I was, when COVID hit, I bought the house I'm in now, and I think I was at a 3.5% mortgage, something like that. And I would have never in a million years thought I'd end up refining, but when I got 2.49, I jumped all over it. And so there are a lot of people in there, 2.5, 2.75, 3%. And so therefore, those individuals, now it will, when they go to buy a new car, let's say it's a 5-year cycle on a car, or ultimately they need to sell. There's going to ultimately be attrition in the housing market. We haven't seen it yet, and it's been well discussed that a lot of people like that, like myself, who might normally downsize, have no incentive to, because you're going to be paying more for a smaller house because you're looking at going from a 2.5 to a 7+% interest rate. Okay, so where I'm going, I'm not trying to ramble here, is that there will be a reset. The corporations that have this debt, individuals, it's just such a lag. And now the problem is that the Fed, they're raising, and they're not seeing the abatement. Inflation's come down obviously over the last year or so, but what I heard Powell talking about, I was doing the video yesterday during the press conference, but then I caught part of it, and he talked about he had one point where he talked about core inflation. For those of you not familiar, core is the food and energy component, which is the most volatile. So a lot of times when they cite inflation numbers, they'll strip it out and say inflation minus core, minus food and energy, because they're so volatile. But what he said is it's actually core that will ultimately determine and cause real inflation. So why they sometimes are taken out of the numbers just because they're short-term swings being so volatile, they are very much, if not the single most important component of the consumer price index, of inflation. And so, as I've been saying, crude has been shooting up, and crude is the largest component of energy costs, right? And it's got a big resistance level right here I've been talking about. So we'll watch this. So when this starts to break out, because the market, a lot of what I saw in the headlines today released is the market was cheering the fact they believe the Fed is done, even though Powell said that they may not be done, right? Powell says what he's going to say, and I truly believe it. It's going to be a while to the next meeting. And if this happens, guess what? We're going to see another rate hike. If this happens and crude oil falls back down here, then we probably won't see another rate hike. I don't want to oversimplify it, but I'm giving you things to watch. And these aren't developments that are going to happen today, tonight, or tomorrow. These are developments to watch over the next month or so. Where does crude go from here, especially if we break out and starts to have another leg up here? That's going to impact things. And then again, at the end of the day, and just to bring this whole thing home, all along since before this bear market even started, my working theory has been that we're looking at a much longer, slower, prolonged, and deeper bear market and recession than we've seen in decades. And that all kind of meshes so far. Now, the fact that the S&P is breathing, close to all-time highs, it's not there yet. It's still below there. And whether or not it takes that high or makes a marginal new high, when you look at the big picture, once that rise in interest rates, which is real, the rise is real. The impact is unlike all points in previous history, because we've never had a 15 plus, almost 20-year period of artificially low, suppressed, near zero rates. And again, for that reason, a lot of companies and businesses are locked in, but not forever. There will be bonds coming due, a lot of corporate debt coming due eventually, starting to roll over, and it's going to roll from 2-3% to 7-8%, or whatever the rates are at the time, possibly more. We'll watch that. Same thing with the consumer. Ultimately, people are going to die and sell their homes, or those homes will be sold, I should say. People will end up having to move for work. People may end up having to sell the home for financial hardships and other reasons. So there'll be that attrition that eventually is going to start to turn over that real estate, those homes that are being sat on right now for low rates. And automobiles, there's another great example. Cars are going to have to, they don't run forever. And so you will see that. And that impact is going to, especially if I'm correct on rates, where rates are going, that's going to put the kibosh on the stock market. So take everything I just said in the last 10 minutes about long-term interest rates, inflation, people and companies being locked into low rates, and put about a 0% weighting on your current trading. This big lightning strike. We've got a big thunderstorm going on here. Put about a 0% weighting on all that. Right now, today, tomorrow, next week, what I'm watching are the short-term levels. I'm watching 375.40 on QQQ. I'm watching to see if the SOX is going to get rejected off the back test of this trend line right here, the uptrend line. I'm watching to see if Apple and Amazon are going to crap out or rally after earnings. Amazon currently back testing the trend line here with big negative divergences. Apple also in a clear and unmistakable uptrend, but with clear and unmistakable negative divergences, overbought conditions. So another one that I would put good money that it's going down after earnings. And so that's what I'm watching near term. So hopefully that makes sense. I go from talking about, the outlook for the next 5 to 10 years, and now I'm talking about the outlook for the next 5 to 10 days, or, 5 days to 10 weeks. And so please don't confuse the two. All right, this has been Randy Finney with Right Side of the Chart.